In 1944, the world tied its fortunes to the US dollar. An alliance forged at Bretton Woods, locked in with oil, and soon so dominant that global trade itself bowed to American control. But today, the world's biggest economies are amassing over 6,000 tons of gold, building digital currencies, and constructing payment networks to bypass the old order. This is gold, crypto, and the new financial Cold War. A global struggle waged not with missiles, but with bullion vaults, blockchain, and sanctions that freeze entire nations. Why are BRICS and the West now battling for the world's wallets? And what would happen if the dollar empire finally cracks? In July 1944, delegates from 44 nations gathered at the Mount Washington Hotel in New Hampshire, determined to build a new global order from the wreckage of war. Over 3 weeks, they hammered out the Bretton Woods Agreement, a blueprint for economic stability anchored by the US dollar. The plan was simple in theory. Every major currency would peg its value to the dollar, and the dollar itself would be convertible to gold at $35 an ounce. To enforce this system, the International Monetary Fund and the World Bank were created, giving the US a central role in managing post-war finance. The dollar, backed by American gold reserves, became the foundation of global trade. Foreign central banks could exchange their dollars for gold, a promise that kept confidence high and trade flowing. But by the late 1960s, strains began to show. US spending soared on the Vietnam War and domestic programs, flooding the world with dollars. Foreign governments, especially in Europe and France, grew uneasy, watching American gold reserves shrink as more countries demanded conversion. The math no longer worked. There were simply more dollars abroad than gold in Fort Knox. On August 15, 1971, President Richard Nixon addressed the nation on live television. He announced a freeze on dollar-to-gold convertibility, ending a 27-year-old promise. The world shifted overnight to a fiat system, where the dollar's value rested not on gold, but on trust in the US government and economy. The collapse of Bretton Woods didn't end US financial power. Instead, it set the stage for a new era, one where the dollar, untethered from gold, could circulate without hard limits. The institutions born at Bretton Woods, the IMF and World Bank, remained pillars of the global system, but the plumbing had changed. The dollar was now backed by confidence, liquidity, and the networks built over decades. This shift would shape every financial contest to come, as rivals looked for ways to challenge a currency no longer bound by metal, but by the reach of American influence. Oil became the new anchor for the dollar in the 1970s, creating a self-sustaining cycle that would define global finance for decades. After the end of gold convertibility, the world's thirst for energy collided with a new pricing reality. OPEC nations, led by Saudi Arabia, agreed to price oil exclusively in US dollars. This wasn't dictated by a single treaty, but by a series of economic incentives and quiet understandings. The United States offered military protection and access to its markets, while oil exporters gained a stable currency for their trade and a safe place to invest their growing surpluses. As oil prices soared after the 1973 embargo, dollar revenues flooded into the treasuries of Saudi Arabia and other Gulf states. In 1975, Saudi oil earnings alone reached nearly $27 billion, up from just $655 million a decade earlier. These petrodollars didn't sit idle. With limited opportunities to invest at home, OPEC nations recycled their dollar windfalls into U.S. Treasury securities and deposits at major American and European banks. From 1974 to 1981, OPEC's current account surplus totaled $450 billion, most of it funneled back into the U.S. financial system. This cycle, dollars out for oil, dollars back in through investment, deepened the world's dependence on the dollar. Nations everywhere needed dollars to pay for energy, driving up demand for the currency and for dollar-denominated assets. The U.S. government, in turn, gained a reliable source of funding for deficits and global influence. Even as the gold standard faded into history, the petrodollar system created a new kind of liquidity, one grounded in the world's reliance on oil and the dollar's central role in settling those trades. The arrangement was never just about economics. It reinforced America's position at the heart of global finance. By the late 1970s, the dollar wasn't just a currency. It was the bloodstream of international trade, with oil as its beating heart. This foundation would later prove both a source of strength and a point of leverage in the financial Cold War to come. In the spring of 2014, as Western sanctions tightened around Moscow after the annexation of Crimea, Russia's central bankers faced a stark new reality. The Bank of Russia, led by Elvira Nabiullina, began quietly reallocating its reserves, moving away from U.S. treasuries and euro assets toward gold. Internal accounts from reserve managers described the urgency. We needed liquidity you couldn't freeze. Over the next 2 years, Russia's official gold holdings nearly doubled, climbing from just over 1,000 tons in early 2014 to more than 1,800 tons by the end of 2016. Gold, stored in Moscow's own vaults, offered insulation from foreign legal reach and asset freezes. This pivot wasn't just about stacking bars in underground vaults. Behind closed doors, Russian officials and analysts debated how to make gold not only a shield, but also a usable tool for trade. The challenge was clear. Physical gold is secure, but slow to move and hard to deploy in modern finance. By 2019, a new approach emerged on the global stage: tokenized gold. That year, Paxos launched PaxG, a digital asset backed one-to-one by London Good Delivery Gold, allowing ownership to be transferred instantly on blockchain networks. Each token represented a specific ounce of gold in a vault, with serial numbers and audit trails published for transparency. Tether Gold, XAUT, soon followed, using Swiss vaults as its anchor. A Paxos representative described the vision. We wanted to create a bridge between the certainty of physical gold and the speed of digital settlement. For central banks and sovereign funds, tokenized gold offered a new way to hedge against sanctions, combining gold's independence from Western control with the liquidity of digital assets. While actual volumes remained modest, the logic was clear. Gold could move from a static reserve to a dynamic on-chain instrument. This innovation set the stage for a larger BRICS accumulation strategy and hinted at how bullion might once again become a weapon in a new kind of financial Cold War. By early 2025, BRICS central banks had amassed over 6,000 tons of gold, more than a fifth of all official reserves worldwide. Russia and China dominate these holdings, with Russia reporting 2,335.85 tons and China 2,298.53 tons, according to World Gold Council figures. India, Brazil, South Africa, and new BRICS. Plus entrants like Egypt contribute hundreds more, each following their own strategy, but united by one principle: gold is beyond the legal reach of foreign powers. Accumulation has been systematic. Russia steadily sold U.S. treasuries since 2014 to fund gold purchases, while China's central bank made discrete, ongoing acquisitions through 2024 and 2025. India began repatriating gold from London, citing the need for direct control in a shifting geopolitical climate. Customs and insurance records point to large insured shipments of bullion flown from Zurich and London to Moscow and Beijing, often under heightened security and with little publicity. Physical custody now takes precedence. After the Crimea sanctions in 2014, Russia moved most of its gold from London to Moscow, insulating reserves from Western freezes. China stores nearly all its gold in domestic vaults, tightly controlled by the central bank. India and South Africa, once split between home and foreign storage, now increasingly favor domestic vaults. Legal frameworks have evolved alongside these moves. Russia, China, and India have enacted statutes granting sovereign immunity to central bank gold, explicitly shielding these assets from seizure or freezing by foreign courts. At recent BRICS summits, officials discussed harmonizing such protections to keep gold flows and swaps within the bloc out of Western legal reach. For BRICS, gold is more than a hedge. It underpins swap lines, secures emergency loans, and anchors multilateral projects, a reserve built to withstand financial warfare. In February 2022, Western governments executed a coordinated freeze on Russian central bank reserves, blocking access to more than $300 billion held across the US, EU, and allied jurisdictions. Overnight, Russia lost half its official reserves, including assets parked in major European and American financial centers. The US Treasury and EU regulators moved in lockstep, targeting not just state assets, but also the global messaging infrastructure. Russian banks found themselves locked out of SWIFT, the backbone of international payments, severing their ability to process cross-border transactions in dollars and euros. European banks, under pressure from both sides, scrambled for exemptions to keep energy and food supplies flowing, but the main arteries of Russian finance were cut. The mechanics of this financial offensive had been refined over a decade. In 2018, the US Treasury reimposed full sanctions on Iran, ejecting its banks from SWIFT and threatening secondary sanctions against any foreign institution that defied the embargo. Iranian trade collapsed, with the country forced to rely on barter, clandestine gold shipments, and early experiments with crypto rails. Venezuela faced a similar fate in 2019, when US authorities seized control of CYTGO, the country's most valuable overseas asset, and cut PDVSA off from the dollar system. These cases established a clear pattern. The US could reach deep into global finance, freezing assets, blocking payments, and forcing banks worldwide to choose between access to New York and business with sanctioned states. Sanctions lawyers describe this as the era of secondary sanctions, a doctrine that extends American legal reach far beyond its borders. Any bank, anywhere, that processes a dollar transaction can be targeted. Venezuelan traders recount how deals unraveled overnight, as counterparties refused to touch anything linked to PDVSA. In interviews, compliance officers recall late-night calls and urgent reviews of client lists, knowing that a single misstep could mean exclusion from the global system. By 2022, the toolkit was fully operational. Asset freezes, SWIFT cutoffs, and secondary sanctions worked in tandem, scaling from targeted measures to a near-complete financial quarantine. The message was unmistakable. The infrastructure of global finance could be weaponized at speed and scale, leaving sanctioned states scrambling for alternatives. Engineers at the People's Bank of China spent years refining a payment system that could carry the weight of cross-border trade without relying on Western networks. The result? CIPS, the Cross-Border Interbank Payment System, now connects 176 direct participants and more than 1,500 indirect ones across 121 countries. In 2024 alone, it processed over 8 million transactions, moving nearly 175 trillion yuan, or about 24 trillion US dollars. Most of these flows are still tied to Chinese trade, and the vast majority of participants remain indirect, routing payments through a handful of major banks with full access. For all its growth, CIPS remains a specialized rail, efficient for yuan settlements, but not yet a true substitute for SWIFT's global reach or the dollar's deep liquidity. the push for digital currency adds another layer. The ECNY, China's central bank digital currency, has been tested in cities and border zones, and now features in cross-border pilots with Hong Kong, Thailand, and the UAE through Project emergence. These trials show real-time settlement between central banks is technically possible, but engineers admit the hurdles: harmonizing compliance rules, managing foreign exchange in real time, and respecting each country's sovereignty over data. For now, these systems offer a glimpse of what's possible: a parallel infrastructure, functional but limited, designed to insulate trade from sanctions and external shocks. The ambition is clear, but so are the boundaries. Progress measured in pilot milestones, not global transformation. Central bank digital currencies, or CBDCs, have been pitched as the next leap in sovereign money. But the reality is less straightforward. The promise of instant, state-guaranteed settlement runs into a web of technical and political trade-offs. A researcher at a leading CBDC pilot describes the challenge. You can achieve finality in seconds, but only if every party agrees on compliance, privacy, and governance rules. In cross-border pilots like Project emergence, central banks from China, Hong Kong, Thailand, and the UAE can settle trades in real time. Yet each country demands strict control over its own data and legal jurisdiction. Harmonizing KYC, Know Your Customer, requirements and anti-money laundering checks across borders has proved far harder than the technology itself. Permissioned ledgers, favored by bank consortia in the West, offer a different model. Here, settlement relies on a closed group of trusted institutions, each with veto power over changes to the rules. This structure can speed up payment versus payment and delivery versus payment transactions, but it also creates fragility. A single regulatory dispute or governance breakdown can halt the entire system. Legal experts point to emergence's ongoing hurdles: questions about liability, dispute resolution, and the risk of one participant's compliance issues rippling through the network. Digital sovereign money may be fast, but it's not a cure-all. The core tension remains: how to balance speed, control, and resilience in a world where financial rails are becoming both more digital and more divided. Dollar-pegged stablecoins have become the go-to bridge for moving money fast across borders, sidestepping the friction of traditional banks. Companies like Circle and Paxos tout instant settlement and global reach, with USDC and previously BUSD circulating billions daily. A Circle executive describes the appeal: "You can move value anywhere in the world in seconds with the transparency of blockchain." But that speed comes with trade-offs. When the New York Department of Financial Services ordered Paxos to halt new BUSD issuance in February 2023, it sent a clear warning. Regulatory oversight can shut down even the most widely used digital dollars overnight. Behind the scenes, compliance teams at stablecoin issuers pore over blockchain data, freezing tokens linked to sanctioned addresses. Chainalysis analysts estimate that less than 0.2% of all crypto flows touch sanctioned entities, far below the headlines, but enough to draw scrutiny from Washington and Brussels. The collapse of Terra's algorithmic stablecoin in May 2022, erasing $40 billion in days, underlined the fragility of unbacked models. Asset-backed coins remain dominant, yet their existence depends on access to the banking system and the goodwill of regulators. As governments debate new rules, the promise of borderless, censorship-resistant money runs headlong into the reality of legal and political risk. The dollar's grip on global finance rests on something few rivals can match: the sheer depth and liquidity of the U.S. Treasury market. With more than $25 trillion in treasuries outstanding, central banks, pension funds, and corporations know they can buy or sell enormous sums in a matter of minutes, without moving the market. This liquidity acts as an anchor, making the dollar the default choice for reserves, trade, and settlement. A Bank for International Settlements analyst summed it up. The world's plumbing is both global and American by default. Change happens slowly, by pipeline, not earthquake. Even as new systems and digital currencies gain ground, the inertia of contracts, legal frameworks, and established habits keeps the dollar at the center. For now, most governments and institutions continue to prize the safety and flexibility of dollar assets, reinforcing the status quo. Asset managers watching these developments describe a world where financial rails are splitting into rival camps, each with their own rules and risks. In one scenario, regional payment networks, like CIPS in Asia or BRICS Pay, become the backbone for local trade, while the dollar remains central for global finance. This partial fragmentation means higher costs for currency exchange, more volatility in emerging markets, and new hurdles for companies operating across borders. Trade data shows BRICS Plus now accounts for over 45% of global trade flows, much of it increasingly settled outside the dollar. But full bifurcation, where blocs close off their financial systems and capital controls return, is a different story. In that world, asset managers warn of sudden liquidity shortages, sharp swings in asset prices, and a scramble for trusted collateral. Everyday citizens could face new barriers to sending money abroad or investing outside their region. For markets, the trade-off is clear: more autonomy and resilience for some, but less efficiency and greater uncertainty for all. In March 2022, over $300 billion in Russian assets were frozen by Western governments, marking the largest financial freeze in modern history. This action followed decades of US dollar dominance, built on the foundations of Bretton Woods in 1944 and the petrodollar system of the 1970s. The documentary has shown how, in response, BRICS nations have accumulated more than 6,000 tons of gold and accelerated the rollout of alternative payment rails like CIPS and ECNY. Yet, the true resilience of these new systems, and whether they can match the depth of the $25 trillion US Treasury market, remains uncertain. Some documents on cross-border enforcement and digital currency design are still classified or incomplete. What is clear is that monetary power now depends not only on reserves, but on who controls the rails. As official records confirm, this financial Cold War is being fought with data, code, and gold, and its outcome will shape the global order for decades to come.